Let's bring in Shane Obata for his take on the market. Shane, first of all, thanks a lot for joining us.
Thanks for having me.
You've said in some recent commentary that the inverse relationship between yields and tech stocks is approaching extreme levels. Unpack that for us.
Just to say, when rates are up, tech is automatically down. Of course, it's not always that simple. So I think it's the same as last year, right? We saw rates risk really manifesting most in the long duration tech sector. So we've seen that again. We're still optimistic that rates are peaking out, specifically on the 10-year yield, though that's not been the case this week. We briefly dipped under 4, and now we're coming back up after the PPI numbers. But I think taking a step back and probably oversimplifying a lot, perhaps this is all just normalization after many years of very weird things happening. So we went through COVID and the world came to a halt, and then we came out of COVID and supply chains weren't exactly ready for the demand that occurred, pent-up demand. And so that didn't help on the inflation front. Neither did the fiscal transfers that happened. And then eventually we got through that. The war in Ukraine happened. That shot commodity prices up again. And I think the world is slowly getting back to normal. So I'm optimistic that in getting back to normal, hopefully inflation doesn't reset higher, which is what I think some people are worried about. And I mean, reset structurally higher. So hopefully we're getting back to that. And then we can just focus on the stock market, on stocks.
There's a graphic that you suggested we put up on a screen, and we'll do that now. It's the NASDAQ Composite Index, and you think this shows the NASDAQ 100 is in overbought territory, i.e. too high. Explain this graph to us.
There's two pieces to the story. So this was highlighted by Bespoke, as you can see on the screen. And they basically said, this level of this kind of overbought reading, this happened about a month ago. I think it was around July 19th. This kind of overbought reading typically leads to a little bit of short-term weakness. However, the main point in sharing this graphic was to say that it's only ever occurred 7 or so other times, 6 or 7 other times.
And that's, if we just put that back on the screen, that's what the red line, I think, is showing us, right? The red line shows us where we are now in terms of the NASDAQ 100 being significantly above its 200-day moving average. And the red line traces back into history. And you can see the other times, the 6 or 7 other times, as you note, that the white line has bumped into that red line.
So the less important takeaway in my opinion is near-term risk after that reading, to say that it's normal after that level of overbought activity to pull back a little bit. But the overarching and more important part is that these kinds of overbought readings don't occur in bear markets. And subsequently, over the course of 12+ months, historically, we've seen much bigger gains than what is normal for the market. So I think that's the main takeaway, and the main reason for sharing that is to say those overbought readings, while they might have some short-term negativity, indicate a broader structural uptrend.
To Gerald, he's our first email writer. The subject here is Verizon, ticker symbol VZ on the New York Stock Exchange. He writes, can you give me your opinion on Verizon at this time for a long-term hold?
You'll get a dividend. That's what I can say. The valuation, as everyone knows, is very, very low. But the U.S. telecom space is tricky right now, and I think that part of the reason it's got such a low valuation is because the earnings growth outlook is not great. And so for a company where you would expect over time low double-digit sales growth, low double-digit earnings growth, it's really not that convincing of a long. And what we're seeing right now is that while the wireless business seems to be turning the corner, this is a company that's going to be faced with higher interest expenses that are really going to eat into the profitability picture. So I can't recommend this as a table pounder. I do think it's cheap. I do think the dividend is safe, but otherwise we are not fully convinced on this one.
The yield is almost 8%, so I guess that's what you're talking about when you say you will get a dividend and you feel that is safe, because 8% is almost warning territory sometimes, isn't it?
That's right. There's free cash flow to support it. They know their shareholder base likes dividends. I'm not worried about it in the near term.
Okay, let's go to Phoenix, Arizona for our first call of the program. Taraver is in Phoenix, Arizona. Hi, Taraver.
Well, hello, Paul. And my question is on Visa. And recently, based on very high credit card network fees charged by Visa and MasterCard, a bill is at the U.S. Senate that would allow merchants to use unaffiliated networks, which means the Visa and MasterCard profit would go down. Is this not a serious risk? Can you please help us understand? Thank you.
I think opening up the market to other potential providers outside of Visa and MasterCard doesn't necessarily mean that adoption is going to happen. And so Visa and MasterCard have this value proposition whereby consumers need them, merchants need them. So everyone needs the network. These are really tremendous, probably some of the best companies in the world. So I think you can own both. I think your question was more about Visa, but this is a company that you can hold for the long term. So we're not too worried about that, though it is a slight risk. But like I said, that doesn't mean that they're going to get completely disintermediated.
Okay, thanks for that call, Taraver. Let's go to Toronto now. Angelina is on the line. Hi, Angelina.
Hi, good morning. I have a question on Paramount Global. I bought it at a high. I've lost, thankfully, I have a very small position, but I've lost over 60%, 67% of it. So my question is, going forward, what do you think of it? And should I hold on? Because with that little bit, I have to find another investment that would go up 3 times as much, or just leave it and hopefully see what the future brings. Thank you very much for your help.
Paramount is a potential takeout target, we think. It's a digestible size, but it's not just when you think about Paramount and the picture side of the business. There's also a broadcast business within this that makes the story a little more muddled. I would say on the bright side, you have Berkshire Hathaway that's supporting your hold of this name. They're, I believe, over 15% of the holder base now, which is interesting to us. So this is one that we've looked at, but I'm not so sure about the case yet. I think media in general is kind of challenged right now. You've had it's gone full circle, right? Netflix, we were worried about profitability. Now Netflix is doing streaming in a profitable way, and all its competitors are burning cash.
Yeah.
So it's become a tough environment, right? And following, I was going to say potentially look at Disney, but even Disney just hiked prices 20%. We're talking 14, I think it's $13 or $14 US per month now. That seems pretty steep for a library that people tell me that they exhaust pretty quickly. So it's a tricky space, let's put it that way. But this is certainly not at the high end of our pecking order, but we're looking at it.
Okay, thanks for that call, Angelina. Let's go back to the email inbox. Jim is the email writer. His subject is Oracle, ticker symbol ORCL on the New York Stock Exchange. What do you think of Oracle, he writes, for a retirement plan?
Oracle, I think, is pretty safe. It's kind of flown under the radar, but it's performed really well. You can see the chart there until paring back, but it's had a good run. And we think it's grounded in fundamentals. The stock is not too expensive right now, especially relative to some of the other technology names. And what's interesting about Oracle is that they are a cloud. They are a cloud player. And while they're much, much smaller than AWS, Azure, Google Cloud products, GCP, they're still growing very quickly. So I think that interest and that AI angle could continue to support the stock. But I think it's a safe long-term hold. Maybe not our top pick in technology, but it's probably safe.
Walter's on the line from Hamilton here on Market Call on BNN Bloomberg. Walter, what's your question to Shane Obata?
Good afternoon, gentlemen. Please, the outlook for Motorola Solutions and its communication and security services appears good. However, your assessment of the stock, is it overpriced, or would you start a position today? Thank you.
We've owned Motorola Solution for a while right now, and it's an interesting business. The legacy business is on the radio side. It's for kind of mission critical communications for firefighters and construction, et cetera, et cetera. So that business was one that I think the bears thought would kind of peter off over time. It's been pretty strong. It's been a good profit engine. But what got us interested in this company is kind of the public safety side, which I think is a really important theme. So they have, for example, a number of solutions, but one of the interesting ones is the video security solution. So they're making cameras and allowing for the storage and analysis of the footage and whatnot. So that's a business within Motorola that we think will continue to grow at a good clip, over 20% per year. So this is a good name to own. I will say it's on probably the higher end of the valuation range. So your profit potential going forward is going to have to come from earnings growth. We think that will play out, but it is worth noting that it's a little bit expensive, but it's a good company.
Okay, thanks for that call, Walter. Ben is in Bancroft, Ontario. Hi, Ben.
Hello, gentlemen. Thank you for taking my call. My question is on the Apple, of course, the largest of the global and the largest technology company. I'm looking at the low of 124 in January 3rd to a high of 198. Do you think that this is what the analysts call is in an exhaustion gap, meaning it is now falling? And what do you think about the phenomenon of that exhaustion gap, and what is your outlook for that? Thank you. I will listen to your call. Thanks a lot.
Okay. Well, I'm not a technician by trade, but I do think broadly speaking, the tech sector is setting up for a nice year-end rally. We're in a period right now, August and September, where seasonality is usually not as good. When I was on previously, I was hoping not to jinx myself by saying the NASDAQ was up 15 Julys in a row, and we just went through our 16th one, so that was great. Apple's obviously pulled back recently. People are trying to get ahead of the bottom in the wireless, in the handset market and the PC market. So maybe it's pushed out a little bit further, but on the fundamental side, we think this is one of the best businesses, if not the best business in the world. The long-term thesis here is really just extracting more subscription value from the installed base of devices, which is to say getting people to use more Apple Music and iCloud and all of these other services. That's where the long-term value will come from. And we know the market likes subscription-based models, consistent revenues. So iPhone's still very important. But I think the bulls have correctly noted over the past few years that the story has been about services. And we continue to believe that's the case. So it's a great long-term company.
Okay, thanks for that call. Albert is in Ottawa. Hi, Albert.
Hi, thank you for taking my call. What's your opinion on Logitech LGT.B?
I think that was Logitech, right?
Correct, yep.
Logitech, I think everyone's probably heard of it in some way or another, whether it's your mouse, got our Logitech mouse here, cameras for your webcams, whatnot. So it's computer peripherals mainly. The stock has done pretty well recently, I think, as we think about the potential recovery in the PC market, and also getting past the COVID brought on this video conferencing is the future trend, obviously, and then that paired back, and now we're going in the other direction. So I think Logitech is an interesting name. I wouldn't buy it currently, but it's something that we're watching for. I think the PC market is in the process of bottoming, so that should bode well for Logitech. But I believe they made an acquisition in the video conferencing space, and that's one we're not so sure about. I think the growth outlook has changed a lot. So it's on our radar, but we're not participating right now.
That huge run up in the stock in May was after Logistech announced a strategic review, which is very often interpreted by investors as the company being willing to put itself up for sale. Welcome back. Let's look at Shane Obata's past picks. Shane visited with us here on Market Call on November the 4th last year, 2022. And one of his top picks on that day, Amazon.com, trading then at about $91 per share, trading now at $137 and change. That is a return in total return of 51%. Shane.
It's been good. I think you stay long. We know the story with Amazon, especially under Bezos. They got away with growth with no regard for profitability for a very long time. And people rightfully understood the vision of just deepening the infrastructure, right? And so now in this new market, we have a company that's only just starting to turn the corner on profitability. So we know that net income margins, for example, are very low single digits for this company. So there's a lot of upside. And there's a few pieces to the puzzle. The first one is getting through and now realizing some efficiency on the retail side. All the investments that were made during COVID to double the fulfillment network, get one-day delivery going. Now they're looking at it through an efficiency standpoint, realizing some cost savings. So the retail business is coming together nicely. Then we also have what we're expecting is an acceleration in AWS in the second half of the year, partially as a result of comps because there was optimization programs that were happening last year. And then also we have a blossoming advertising business. And so as AWS and the advertising business become a larger part of the total company, that will also help profitability. So it's really just show and prove now, and we think that they will. Okay. That was top pick number one on that day in November last year. PepsiCo was number two, ticker symbol PEP on the NASDAQ, recommended at about $179 per share, now trading at just under $184 per share. That's a return of 3%. That's share price appreciation. Include the dividend, and you get a return of 5%. Still one of our top picks in the staples sector. We are worried in general about how sustainable pricing power is with staples, but these companies keep proving us wrong. And what I mean by that is I think we've all heard with some of these companies that top line growth is challenged. And so, or sorry, I should say unit growth is challenged. And so to make sales go up, we've seen very high pricing increases. And so I think taking a step back, Pepsi is a great operator under the current CEO. They've done quite well in beating expectations. And they've got a good portfolio of assets. Most of the operating income now comes from the snack side. And I think snacking is just something that has become bigger and bigger because people are busy. They want to get something in quickly. So Pepsi said that right now on the snack side, they think they're probably involved in about 2 out of every 6 daily instances of snacking, and they want that to increase that. And that could come from partnerships to allow them to expand into products that people can use at home and products that people can use in the office, those kinds of avenues. So it's still a good company, but we're worried about pricing. Okay. Finally, Deutsche Telekom was the third top pick on that day, ticker symbol DTE. And where is that trading, Shane? ETR listed there. Is that a European exchange? Germany. Germany, okay. Yeah. Recommended at 1955 euros, now trading at 1880 euros, 18 euros and 80 euro cents. Total return of negative 4%, but cushioned by a dividend, which reduces the decline to 1%. It was doing a lot better until recently, as you can see there. So in March, April, this had been a great stock for the year, and this is our way to access T-Mobile. Deutsche Telekom is the majority shareholder in T-Mobile, around 50%. And this is a way to get a dividend. You get a stable and very slowly growing European business, but also access to the T-Mobile business. Now, I think the reason it's been disappointing recently has been concerns around more competition in the States. We know that there is potential, for example, Amazon and Dish partnerships. We're not sure how that's all going to pan out, but we have seen that the cost of wireless plans in the States are a lot more expensive than they are in Europe, for example. And so perhaps people are thinking, okay, we need more competition, we need lower prices. So that, I think, is weighing on the sector. But coming back to just cash flow, we know in the States and for Deutsche Telekom as a group that CapEx is expected to come down meaningfully. So that should really help free cash flow. Supporting the dividend, we think more buybacks, more dividends on the way. So we're staying long.
Okay, those are Shane Obata's top picks from November of 2022. We'll be back with Shane right after this. He's portfolio manager of Middlefield Capital, and he'll continue taking your questions on global stocks and tech stocks. Okay, let's get back to questions to Shane. Henry is our next caller, and he's in Vaughan, Ontario. Henry, thanks for calling. And Henry, you're going to have to turn off your television, please. And I'm going to direct the question right to Shane so we can get to it. Taiwan Semiconductor is the topic. What do you think of this stock?
Great company. It's the biggest foundry in the world. I think their market share is around 60%. So when we talk about semiconductor foundries, that's basically building the chips for all these household names such as NVIDIA, AMD, et cetera. So Taiwan Semiconductor is a major player. Samsung's a major player. We know that Intel is trying to build out its own foundry division. Taiwan Semiconductor has the best technology in this space, and I think that will allow this stock to continue working over time. Recently, we've seen that they are seeing some benefit from AI-related demand, but it hasn't been enough to offset weakness in other parts of the market, such as the handset market, which we talked about earlier. And we know that the PC market's turning the corner, et cetera. So I think you got to be a little bit patient, but over the next few years, this should work out nicely.
Is it at risk because of tensions between the U.S. and China over technology in particular?
So I thought you were going to go towards the invasion risk, but we think that one has receded. But I'm hoping that we're getting to a point now where the U.S. and China cannot ratchet tensions higher, because I don't think it's good for anyone. I do think the stance that the U.S. has taken is appropriate, but you have, for example, many American companies telling the States that you're going to crimp American business by doing this. So hopefully that gets better, but yes, there's certainly some risk there given the American customers.
Okay, let's go to Peter. Peter's on the line. Hi, Peter.
Good afternoon, gentlemen. My question is on Walt Disney, the stock price in the next 2 to 3 quarters. Can I gather any magic out of that kingdom? Your thoughts. Thank you.
I see what you did there. Disney has great assets, for sure. We've followed it for a number of years, and we were interested. The franchises are great, right? We're talking Marvel, Star Wars, Pixar, the list goes on. I do think the story is quite tricky right now, though we have become more interested in the name recently, just because there's so much going on at once. So, for example, within this broader company, you have a linear TV business, which is in secular decline. The company's trying to figure out ESPN. You have Disney Plus that's having some losses, operating losses. And then we're also concerned here that we're reaching kind of franchise fatigue. For example, Disney being as big as it is and as powerful as it is, we're talking about $200 million production budgets for the movies, and then another $100 million for marketing purposes. So the bar is quite high, right? And flops can be very costly. So I'm just rattling some concerns off of the top of my head. It's a great company with great assets, but there are some tricky parts right now. Last thing I would just say quickly is that the parks business has been very resilient, and if that turns over, that's going to be tough for the whole group.
Okay, thanks for that question. Let's go to Karen. She's in Waterford, Ontario. I believe that's close to Brantford, Ontario. Hi, Karen.
Hello. I'd like to ask about the likes of American Tower and CCI as they are suffering. Your views in this area, please, as potential buys, or possibly just go elsewhere. Thank you.
Okay, the sound quality was not good there. American Tower is one of them. I missed the other stock. She's asking.
I think it was CCI.
CCI. Okay, I think you're correct. Okay, can you give us your view on American Tower and CCI?
Towers have had a tough year, and that's somewhat expected given they are arguably the most duration sensitive part of the real estate sector. Very long-term contracts. They trade like bonds. And so they've been under pressure. American Tower, I think, is the safest of the bunch. It's well diversified. They've actually seen in the recent quarter that initially we had thought, okay, we want US-focused growth. It's safer, less FX impacts, et cetera. And now the international growth is actually helping the company. So these stocks have been, as you can see, it's been a tough ride, but we like these businesses. These are good businesses. It's basically an oligopoly market structure. It's very predictable, generally speaking. I think we were talking about telecom earlier. That telecom is moving past peak 5G spending has also weighed on these names. But we like American Tower. CCI, I think, is a little bit more risky, but just know that the fundamental story is there, but this is also highly dependent on what happens to rates.
Okay. There is CCI, Crown Castle International, down 43%, very nearly, over the past 52 weeks. Our next caller is Chris, and Chris is calling from Hamilton. Hi, Chris.
Good afternoon. Thanks so much for taking my call. I'd like to know what Shane's view of Qualcomm is. It seems to be very erratic and jumping around, and it was doing well until, I guess, it released some news, and then it's in the correcting stage. To be quite honest, I hold it, and I was going to sell it when it was at 133, but it headed south too quickly, and I'm still holding it. So I'm just wondering what Shane thinks the future for Qualcomm is, and if he owns it, and what would he do if,
Qualcomm has been tough, as you can see, and as you've experienced. It's highly dependent on the wireless market, and so that's been a negative backdrop. I think with a company like this, it's still a good company. It's quite cheap right now. So while I don't have a position, I would recommend waiting until things are better and then considering if you want to continue to hold it. But it feels like it's been in the dumps for a while. I don't think now is the time to abandon ship.
Okay. Tom is in Aurelia. Tom, thanks for calling.
Thank you for taking my call. I'd like your guest thoughts on Fortinet. It took quite a beating after the last earnings, but would he recommend holding it? Thank you.
Fortinet, thanks for the question. Fortinet is a good company. Obviously, the quarter was not taken well, and expectations were ratcheted downwards. I think this will be a winner in cybersecurity over the next few years. So depending on your time horizon, I wouldn't necessarily abandon this name. That said, we do have a preference for Palo Alto Networks in cybersecurity. They're actually similar businesses, but continue to see the long-term vision in this industry, and I think you just need to be patient. It's done quite well over the long term. I still think there's potential for free cash flow margin improvement and significant growth in free cash flow with these businesses. So I would stick with it. I think it's probably a bit oversold in the short run anyways.
what took it down dramatically, so dramatically recently, that looks like a cut to the annual revenue forecast quite recently caused the stock to fall out of bed. There, you see it there. Okay, let's go to Greg. Greg is in Toronto. Can you hear me, Greg?
Yes. Hello, good afternoon. Shane, I wanted to ask you about Okta, OKTA. They're in cloud security. They come out with, the stock ran up to about $90. They come out with pretty weak forward guidance. And I'm wondering if you would consider this something that would be worthy of buying more of now, or what your feeling is on the company. And secondly, is Okta a company that's likely to remain a standalone company, or you would see it one day becoming taken over by one of the larger companies in the security industry? Thank you. I'll listen to your call. Take care.
Okta is a name that we've been following for a while, and I think the area in which they operate, which is largely around identity verification, is an interesting one, and I think it's a good space. But here you're going to run into heavy competition from Microsoft, for example. So I think many people using the Microsoft's 365 suite have some exposure to the Authenticator app. That would be a similar kind of proposition. We haven't been involved in this name for a while. I do think there is potential that it gets taken out. It's probably a little bit big. It's significantly above $10 billion in market cap, but I think this is a show and prove story for us. They acquired, or they had their combination with Auth0, and from what we heard internally, that was tricky. There was people leaving and whatnot. I think they're getting past that, but we want to see the company perform before we get involved in this name.
Okay. Ray is in Mississauga. Hi, Ray. Thanks for calling.
Hi, I have an interest in TD Bank as a long-term hold. What does your guest think about TD for a long-term hold? Thank you. Bye.
Canadian banks are not expensive whatsoever, so I think you can own the bunch, or you can own TD, or you can own Royal, and I think you'll do fine over the long term. I think they're cheap, and I think part of the reason this is why banks are one of the cheapest parts of the market. We had all, myself included, until earlier in the year, I think we were all waiting for this recession to manifest. Mm-hmm. And of course, banks are a cyclical business. And I think as we move away from that, and we're entering a phase where maybe we get upside surprises to growth, banks make sense now. I think they should be a part of the portfolio for people.
Time now for Shane Obata's top picks. Number one on this day is NVIDIA, ticker symbol NVDA on the NASDAQ. Shane.
It's had a great year, but it's currently pulling back a little bit. But we think that, as I said before, the Q4 should be good for technology. I think investors want to have exposure to some of the momentum leaders, technology industrials, and then you also, I think, dividend growth as a style will also work. So combination of both. NVIDIA, I don't think needs any more introduction at this point. First and foremost beneficiary of the AI investment cycle. The stock is actually, we're more comfortable with the valuation now than we were before the blowout quarter that they had before. Earnings expectations were ratcheted higher, but we think this is just the beginning of the earnings upgrade cycle for the company. They report at the end of August, and we still think that numbers are too low for 2023 and 2024. Anecdotally, we're hearing from different people that it's very difficult to secure the top of the line NVIDIA chips that are used for artificial intelligence applications. For example, companies are saying that you won't, if you're planning to deploy, then it should be Q2, Q3 into next year. The demand is there for sure, and we don't see this petering off anytime soon. So I think this pullback is a buying opportunity.
Okay. NVIDIA, top pick number one. Top pick number two is in the luxury segment, LVMH, often referred to as Louis Vuitton. Why do you like this one?
Global leader in luxury, and what we think is the best portfolio of brands in the world across various segments. So the recent quarter was a little bit weak on the wines and spirits side, but we like this business. It's very resilient. They're diversified across all their different brands. They're diversified across all their business segments, wines and spirits, jewelry, fashion and leather goods being the profit engine here. And similar to what we were saying about trying to think of the other side of things, maybe there's upside to estimates over the course of the next year, in that I don't think the higher end consumer has been under that much pressure. And so as we can move from a mentality of a potential economic deceleration to one of economic acceleration, that could actually lift estimates for this company going forward. And I think one thing that also doesn't hurt is China is lifting its ban on group travel to other countries. China's been a slow recovery, as we know, so I think that will help as well. But our remains our top pick in luxury.
Is there a threat at all from the proposed merger of Coach, Michael Kors, Kate Spade, Versace, and other brands?
I don't think so. That's a good portfolio of assets, but I think LVMH skews even higher. It's not Hermes level expensive, but Louis Vuitton is it's a lot.
Okay. Top pick number 3, Eaton, ticker symbol ETN on the New York Stock Exchange.
Eaton's been a great performer this year. This is mostly an electrical equipment company. So if we think about just the utility space, they're selling products that cover the whole range of from generation to distribution. And part of the reason the company's done so well is because it's U.S. centric. We've seen a lot more volatile economic data outside of North America, and I think it's fine to stick to lean into that. So this company is a key beneficiary of the electrification theme, electrify everything, if you want to call it that. So we continue to think this is a great place to be within the broader clean power space. And so Eaton recently had a record quarter, and they raised guidance for the year. We think organic growth probably tapers off a little bit next year, but this is a great long-term hold. It's a little bit expensive, trades at a slight premium to the group, but we think it's deserved given that they've shown that they can continuously win contracts.
This company makes industrial products for the commercial and aerospace markets, among other things. Shane, I want to thank you for being here, and I'm sure our viewers do too.
Thanks for having me.